Common-size balance sheets are an important analytical tool used to evaluate a company's financial structure, asset composition, and financing decisions. In a common-size balance sheet, each asset, liability, and equity item is expressed as a percentage of total assets. This standardization allows analysts to compare companies of different sizes and evaluate changes in financial structure over time. The program emphasizes that common-size analysis improves comparability and helps identify trends that may not be immediately visible in absolute figures. Analysts frequently use this technique to assess liquidity, leverage, asset allocation, and operational efficiency. By converting balance sheet items into relative proportions, common-size statements provide a clearer picture of a company's overall financial condition. Vertical common-size balance sheet analysis focuses on the relative composition of assets, liabilities, and equity at a single point in time. Assets are typically classified into current and non-current categories, while liabilities are divided into short-term and long-term obligations. Expressing these items as percentages of total assets enables analysts to evaluate how resources are allocated and financed. For example, a company with a high percentage of current assets may have stronger liquidity, while a firm with significant long-term debt may face higher financial risk. Common-size analysis also highlights differences in business models across industries. Manufacturing firms often maintain larger inventories and fixed assets, whereas service companies may rely more heavily on intangible assets and human capital. The program explains that common-size analysis can reveal important trends and relationships within financial statements. Analysts examine whether changes in asset composition align with revenue growth and strategic objectives. For example, rapidly increasing receivables as a percentage of total assets may indicate weaker collection practices or aggressive revenue recognition policies. Similarly, rising inventory balances relative to assets may suggest slowing sales or inefficient inventory management. On the financing side, increases in debt ratios may indicate expanding leverage and higher solvency risk. Common-size balance sheets therefore serve as an early warning system that helps analysts identify operational inefficiencies, deteriorating liquidity, or potentially aggressive financial reporting practices. Horizontal analysis complements vertical common-size analysis by evaluating changes in balance sheet items over multiple periods. In horizontal analysis, analysts compare trends relative to a base year to identify growth patterns and shifts in financial structure. According to the program, horizontal common-size statements make relative growth trends readily apparent. Analysts can evaluate whether asset growth is supported by sustainable financing sources or whether liabilities are expanding faster than equity. For example, rapidly increasing short-term debt may signal liquidity pressure, while consistent growth in retained earnings may indicate strong profitability and reinvestment capacity. Horizontal analysis is especially useful for forecasting future balance sheet relationships and assessing long-term financial stability. Common-size balance sheets also support ratio analysis by providing insight into liquidity, solvency, and capital structure measures. Analysts often combine common-size analysis with ratios such as the current ratio, debt-to-equity ratio, financial leverage ratio, and asset turnover ratio. The program notes that solvency ratios such as debt-to-equity and financial leverage measure long-term financial risk. Viewing these relationships within a common-size framework helps analysts understand how financing decisions affect overall financial health. For example, a growing proportion of debt financing may improve short-term returns but increase vulnerability during economic downturns. Integrating common-size statements with ratio analysis therefore provides a more comprehensive assessment of company performance and risk exposure. Although common-size balance sheets are highly useful, analysts must recognize their limitations. Differences in accounting standards, industry characteristics, business cycles, and management estimates can reduce comparability between firms. Historical cost accounting may also distort asset values, especially during inflationary periods or when significant intangible assets are involved. Additionally, common-size analysis alone cannot explain why financial relationships change or whether observed trends are sustainable. Analysts must therefore combine quantitative analysis with qualitative evaluation of industry conditions, management strategy, competitive positioning, and economic trends. A strong understanding of common-size balance sheets enables analysts to interpret financial structures more effectively, detect emerging risks, and make more informed investment, lending, and valuation decisions within global capital markets.